This session was really on how to look at the financials that support your business case. And for a lot of entrepreneurs who don't come from an accounting background, it was an introduction into what is a balance sheet, what is an income statement, and what's a cash flow. And we actually went through a live exercise and took people through a process so they could see how these entries and these documents actually how they are created. So that was one part. The other big part was what are the elements that should be in a business case, which is a document both to inspire, communicate to potential investors and other partners, and took them through various examples of what's required, and at least a minimum set of things that people look for in a business case that you might submit. These are the two bits, yeah. Finances in a business case, for a business or for a business case are a little more than just checking your bank balance. Okay, because there are a lot of entities involved. So no, your bank account can only tell you what the health of your cash statement is, but you need to know everything else. Is there going to be revenue coming into the future? What are my liabilities, etc.? So the accountants of the world have come up with the technique. There are three really popular statements. There are balance sheets, profit and loss or income statements, and cash flow statements. Okay. So the balance sheet, reports the state of your business on a particular date, and always has two sides: assets, things that you own. And don't worry about getting what these are. I'll give you a handout, and then we'll actually do an activity. Yeah. Liabilities and owner's equity. So when you start a business, right, and you pump in some money out there, right, or you go to a bank and put some money. So any money that you pump in is your equity, is the book value of the. Suppose you put £5,000. That's £5,000 that's under your name. Suppose you go to a bank and collect another £5,000. That's a liability to the bank. Where does that money go? The money goes and sits in your bank as a cash asset. Now, if you spend with that and you buy Sicilian olive oil, right, that's stock. That's still an asset. Now, unless it's an asset that goes bad the next day, right, which is a perishable, that asset can then sit on your balance sheet. So what you've done is you've reduced your cash, you bought an asset. And maybe you're making salads, so that's a raw material going into another product, and that'll get consumed, and you'll make another product out there, and it'll move to a finished good. Customer will buy it, he'll give you more cash. So that's how the cycle goes, and we'll go through an activity of understanding how a balance sheet works. Okay. So some just general explanatory terms. Assets that can be converted to cash in 1 year, typically called current assets. Yeah. So even if you went and bought stocks, something that you could liquidate. If you got long-term assets, if you went and set up a plant and machinery that's not easy to sell or liquidate, those are called long-term assets. Cash is obviously the most liquid asset because you can access it pretty much anytime. Your savings will be in current assets. And then there'll be intangible assets that you normally don't put on your balance sheet, which can be goodwill or IPR, etc., but they typically come into account if you do a sale. If you sell your company and then someone who's buying is willing to give you a premium, that's when some of these intangible assets can attract a value. A profit and loss statement is slightly different. It is just the revenue you earn from the customers, not the cash, the revenue you earn from the customers, your expenses that you've paid out or due to pay out, and the various kinds of profits you made. So we'll just go over the common terms that are used in accounting out there to familiarize you with what this means in terms of profit and loss. So revenue minus costs is profit. That's in a very general sense. But again, you've seen this in your handout. There's a term called gross profit or gross profit, which is really how much did you get from your customer or due from your customer, your revenue, minus what did it cost you exactly to provide that goods or service, all your direct costs. So not your salary as a CEO, not your head office, not your lighting, but really your factory costs, your raw material costs, labor that went directly into this, to give you an idea of gross profit. So when you take out those expenses, which is called cost of goods sold, you get gross profit. After you take out overheads, you get operating profit. So that's what you need. That's what you make after as running as a company, because you've got overheads, you've got central functions. However, you may need to put money aside for tax if you're making some cash profits. You're making profits, so you need to make a provision for that. For tax, so you take the tax out, that's profit after tax, and then you've got that's profit before tax. You may take some depreciation out here, and after you take out tax, you got net income. So it keeps reducing. Yeah. The third statement is cash flow. And cash flow is not the same as profit, and it's not the same as sales. Again, for those who were here for David's session, David talked about what do you need cash for in companies. A lot of times it's working capital. It's the fact that you need to make goods before customers buy them, and you need to buy things to make those goods and pay the salaries and keep the heating and the lighting on, right? Cash is required as working capital. Yeah. So cash flow statement is very, very critical, and is a really important thing in all companies, but even so more in startups, because when startups run out of cash, they stop. Okay. And there are three elements to this. Cash is affected by operating activities, that's sales, yeah, or revenues. You spend money to buy things, to make things, to pay the salaries, to sell, to market things to customers, and when they pay you, it impacts your cash position. So that's operating activities. There's investment activities. You decide that to make robots, I actually need to buy a factory and land and building and machinery to do that. That's investment. Yeah, that's not an expense because that's an asset. And the last is from financing activities. So you take out an HSBC loan, and the £10,000 you've got to pay every year out there is an investing activity. And what happens when you can't pay your salaries? Right? As a director, you have a liability to declare that you have a problem. You have to declare it to the company's house that you may have an insolvency issue. So to go over this roundabout process was to give you, I think, the shortest ever class in accounting out there. But here is one way of looking at something like this. Sorry, we hadn't taken shipping costs. So we took shipping costs out. It was 5,800. I suddenly had a double whammy of 2,000, which was an office expense. Taking it out here, I suddenly had to pay salaries of 3,000, and then I realized I didn't have the cash. So my options at that were to go to run to a bank and ask for money. Now what happens when you run to a bank when you're out of cash and you need money? They look at your accounts and say you're already in trouble, so I don't want to give you money. And then you end up going to a loan shark who wants to give you money at 178% APR, or you use your credit card. So a fictitious accounting activity, but basically to show you effectively everything in one page. Your balance sheet, which is your assets, your liabilities, and your shareholders' equity, and your income statement. Yeah, my apologies. This stuff should have been over here. Your cash position. And your cash position is effectively what is something that you will project in your business plans as cash flow. That means I expect every month on month this revenue, this expense out there, because when this becomes zero, right, this can't afford to happen because you can't have negative cash in your bank unless you take a loan. When that reaches zero is effectively when you stop. So let's get into business plans out here, and a lot of what we've covered here is in sessions 3, 4, and 5. But we're just going to go over what makes a good business plan. Yeah. So regardless how intuitive you feel about your business and whether you're competing in Lions Den or not, it's still a good idea if you decide to do a venture to write a plan, even if you don't need to go and get funding or win a competition, because it puts the discipline and actually goes, the process of doing that is very, very useful for your planning. So there's obviously known reasons for funding and for competitions, but it sort of rejuvenates the journey. If you want to bring more partners on board and say, tell me what your business is all about, it's a bit like a CV of your business. You say, here's my plan. It's also a good idea to say, last year I started out with my plan. This is what I thought. Let's see how I've done. What did I learn? What was different? So it's a living document. Now, we'll show you one way to do a plan, but there are any number of ways to write up a business plan, including a prescribed format for the Lions Den competition, right? There's nobody says that this is the 10 heading or this is the 10 structure kind of thing. So should you go for other competitions or meet other investors, some will have their own style, it'll be their own style. But what's important is that the following things are always expected to be in a plan, even if they're not expected to be in the same order. And I think it's important we understand what those are. And regardless of the style and the format that you choose, you can make sure that this is a very, very good checklist for you to have to make sure what your plan is. So where are you in the business? Now, there were some great entries in Lions Den where between application and they were selected for the files, where they turned around and said, by the way, when I'd applied, I was at this stage in the business, and today I've got a prototype. The next session is going to be about connecting to people with purpose-based pitching. So it is to make your opportunity as close to your heart as possible, make you as comfortable as possible in what you're trying to put across, so that it doesn't look very salesy, and look at other ways to pitch apart from what people understand is an elevator pitch. So it's just trying out different techniques. So there's going to be lots of hands-on activities.